You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, as always, thanks once again for having me.
A huge spike in the price of gold today. Other commodities still either even or falling, and the stock market taking a pounding. And something I want to point out, months and months and months ago, Tim, you warned the price of oil would drop down below $30 a barrel. I'm sure people at the time thought you were absolutely crazy, but you said the numbers and cycles don't lie. Can you maybe explain that?
Yes, the very essence of technical analysis is that everything is discounted into price. And if you stop and really put your mind around that's a deep concept in a way, but it's true. I mean, everything that everybody knows or perceives that they know about a given commodity or stock or whatever, it's discounted into price because their action or inaction, whichever the case may be, it doesn't matter. Everything is discounted in that price. If you think that Walmart's going up and you buy Walmart, then you've affected the price of Walmart. And if you think it's going down and you sell that stock, then you've affected that. And globally, all the participants that are interacting with the buying and selling of that stock, it's all discounted into price. So that is the essence of technical analysis. And then what I do is I take it one step further with the quantification of trend, which is what a cycle is. The trend's up and it trends down, and then you have trends of varying degrees. You got short, and intermediate, and long term, and super long term, and so forth. And so you segregate, if you will, the cycles according to their approximate duration, and you see a clustering of, okay, well, in this market there's a cycle that averages 30 days. In this market there's a cycle that averages 6 months, or whatever the case may be. And then you dissect it, and you come up with statistics, and you go, well, when this happens, this happens. And then all of a sudden you have kind of a statistical roadmap, if you will, that you can use to guide yourself with price. And when I said that about crude oil, I went back and looked, and it was in 14 after we had the failed seasonal cycle advance, which gave us the structural indication that things had rolled over, and it was in the 90s, I believe. And it's just a matter then, okay, at that point the structure's broken, so now where are we going? And so then you apply the quantitative aspect to that, and we did say that it was going into the 30s and probably into the 20s, and here we are. More recently we've had a bounce. Didn't know how long the bounce was going to last. I knew it would last till we got a sell signal, and obviously, we've had sell signal on oil, and the bounce had run its course, and here we go. I think that now we're pushing into a higher degree cycle low later this spring.
So, Tim, taking a look at specific areas, gold today made a huge climb in price, and I noticed, too, that the stocks of the gold miners were the only area on the trading boards that was up.
And, that goes back to the stocks. Again, I identified in the February newsletter that we had an annual degree cycle low based on structure that and let me take a minute and find that section in this letter. And Jim, in the February letter, I talked about how we had the higher degree, the annual cycle in gold, and then how that low occurred in December, and how it was set up. The setup with that cycle concluded with what you call a monthly swing low in January, and that there was a rally of, I guess the best way to say it would be, of intermediate degree at hand. Now, I think based on the 9-year cycle that this advance should be a counter-trend advance with one more push down as we finish making the base for the bottom for the 9-year cycle. But point being, based on statistics, we identified the intermediate term low before this really started. And again, it's just based on it's simply based on statistics. And if you know that a cycle averages so long in duration, and you know that there are structural indications to guide you to say when this happens you have that cycle low, then you can do that. It's really pretty simple. The reason I'm saying now that this advance in gold should be a counter-trend move is because when you look back at the higher degree 9-year cycle, there's always been 9 of these intermediate degree annual cycles within that 9-year cycle. We're on number 8 now. So unless this time is different, statistics suggest that even though we have a heck of a bounce going on, and even though, like I said, I'm not talking out of both sides of my mouth, we identified it. We knew it was coming. Okay, so we're good with that. But what I'm saying is that I think that this advance is going to be followed by one more push down before we get that 9-year low, and then later this year, early next, I think it's probably later this year, we're going to be cocked and locked for the 9-year cycle low.
We'll have more with Tim Cyclesman Wood right after this.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Tim Cyclesman Wood. So taking a look at specific commodities then, what do your cycles tell you about short, intermediate, and long for oil?
Well, oil, I think, obviously the short-term bounce that we had failed. It appeared to be an intermediate degree low as well that has failed. And now I think we're pushing down into what should be an intermediate degree bottom. I think that, that it's like, Jim, it's like coming to intersections. And that's the best way I can describe it. You come to an intersection, and you're driving down the road, and you got an intersection, let's say, every mile. Well, when you come to that intersection, you have the opportunity to turn. And whether or not you do or not, well, I mean, you don't know. And so you look at the structure of the market when you come to that timing, to that intersection, is the timing, if you will. When you come to that intersection, you have the opportunity to turn. And maybe you just zigzag and go, oh, no, I don't want to take that turn. I want to go. So you get a fake-out turn. So that goes back to the structure. You monitor the structure as you come to the intersection. And so what I'm saying is we had the intersection for the intermediate degree low, and it did rally, and now it's failed. So now that opportunity was lost. And so now it's going down this road till we get to that next intersection, that next opportunity, if you will, for that intermediate degree low, which lies ahead. And so we're going to continue down overall until we get to that intersection. I said crude oil until we get to that next intersection.
Mm-hmm. Now, with gold, I know, again, you were somebody who said, this thing is sitting there. Gold and silver sat there going nowhere for 2 years. Now, all of a sudden, we've seen some major jumps in gold. Is this a trend we're going to keep seeing?
We're in the final stages of building the bottom for the higher degree 9-year low. This isn't it. I know the gold bugs have been, gold, it peaked, the 9-year cycle peaked in 2011, and every time you've read the letter, I've said that every intermediate term bounce since then would be a counter-trend move, a counter-trend move, a counter-trend move. And that has proven to be the case. And even this one, as strong as it is, this is the best one we've seen. Well, I can't say that because I haven't put the math to it. It's among the best bounces we've seen since the 2009, or excuse me, the 2011 9-year cycle top. This is a good one. But I still think that it's counter trend. I still think that what we're seeing is the final setup that is going to unfold over the course of this year with gold, and then after the 9-year cycle low is in place and we get to that intersection, if you will, with the structural changes, then I think it's going to absolutely rip. But we're still seeing the setup.
Other commodities, what's happening with them?
I don't follow a lot of the other commodities closely. I look at the CRB index a couple of times a week, and I guess I haven't looked at it this week. The last time I looked, let me pull up a chart of it. All right, I got it. It's just we have the 3-year cycle top. It's broken. They're going lower, and the same with the Baltic Dry index has gotten a lot of attention lately. We talked about that, I don't know, sometime last year, probably in the summer, I think. Time goes by, maybe before that. There was a 3-year cycle advance that failed there, and there's a pretty consistent 3-year cycle with the Baltic Dry index, and then commodities follow that pretty closely. And so, the structure there is broken. The structure, it's been broken. The structure with looking at the CRB, broken. So lower prices.
Of course, Baltic Dry Index, for people who don't know, that's the activity of cargo ships, isn't it?
Yes. And it's a good indication of economic activity as a whole, And so, if goods aren't shipping, then obviously the economy is not doing very, very well. So it all goes hand in hand. And what we're seeing, Jim, I don't remember the interviews run together. You don't remember what you say in one versus the other. But what this is all about is it's the deflationary forces. Remember, we've talked about this, and I said that ever since 2000, everything tried to top in 2000. The stock market, the economy, and we've talked about how the volume characteristics of the market rolled into a secular bear market with the 2000 top. We talked about how the job participation rate, peaked in and around 2000. We talked about the velocity money. Everything peaked in 2000, and then what we have seen since then was the Fed's efforts have been all about reinflating. Well, if you're reinflating, then something is deflating. And that's commodities, that's been stocks, that's been the economy as a whole has been deflating. And all these efforts have been to stop that deflation, that deflationary cycle that has been bearing down on the economy. That's what they've been fighting. Well, as we come out of the 2009 low, again, with all the reinflation efforts, they were able to push the stocks to new high, but they didn't push anything else this time. Last time, coming out of the 2002 low, they pushed everything, housing, commodities, everything went to new highs. This time, all they managed to do was push stocks to the new high. And so now everything has turned, and commodities have been leading in that deflationary, with those deflationary forces, if you will. And that's what we're seeing. It's that simple. And that's what the Baltic Dry Index has been telling us. That's what crude oil has been telling us. That's what everything has been telling us. Gold is sniffing the problem. I find it interesting that gold is rearing its little head, if you will, with this intermediate term advance as it's trying to start the setup for the longer term 9-year cycle low right as the storm clouds are coming on the horizon. It's all perfect.
Some of the gold bugs have told me they expect with the continuing downturn in the stock markets that the demand for gold will outstrip supply, and that's going to very rapidly increase prices. And some were throwing around, again, $5,000 an ounce, $10,000 an ounce. Are those unrealistic numbers?
I need to do some research on that. I have to run some numbers and look. I can't say that yet. Like I said, I know the gold bugs have been looking for the big bonanza, and like I said, they're about to get their chance with this. But I'm telling you, I don't think we're quite there yet because the structure just hasn't quite fallen in place. This is the bottom building process for the 9-year cycle low. And I'll have to do some research on that and see if I can come up with some numbers for you. I've been concentrating more on the decline into the 9-year cycle low and haven't really put any effort in trying to figure out where we're going with the 9-year cycle top until we got the low. So.
And of course you said 9-year cycles, so we're not going to see absolutely highest prices in 9 years.
No. That's not what I'm saying exactly. When I say a cycle, it averages 9 years from low to low, and actually it's not 9 years even. It's more like 8. The last 9-year cycle low came in 2008. This one looks like that it's going to bottom later this year, and the reason I call it a 9-year cycle is because there's a little cycle that averages about 12 months. Sometimes it can be a little short, maybe 10 months, 8-10 months, but over time, the duration of that 9-year period, if you will, or 8-year period, there's a tendency. It's been like clockwork, and there's been 9 of these cycles, annual cycles, within that approximately 8-year period. And so we're on number 9. And so that's why I'm saying we should have another of these annual cycles down, which should finish setting us up for gold for the real rally. And I think this is just that annual cycle, the last annual cycle events before we get there. And again, unless this time is different, every other 9-year cycle has had 9 of these cycles, and we should have one more down before it's complete.
Have negative interest rates in Europe and Japan thrown a wrench into the works when it comes to predicting cycles? Because we've never had them before.
No. Because, well, I say no. It has stretched things further than anticipated. For example, the 4-year cycle advance up into the high that we saw finally in May in equities. Well, historically, that cycle has averaged 48 months from low to low, just like the cycle in gold historically has averaged between 8 and 9 years from low to low. But because of the efforts to reinflate, yes, it's had some short to intermediate term. And when I say short to intermediate term, and I'm saying it in the context of, okay, they've stretched the cycle for, it's really not short term, but in the context of going back to 1896 and looking at 4-year cycles, it is short term, a couple of years. So they've extended this 4-year cycle, true enough, but they haven't negated it. It's going to happen. They did not negate the cycle in that they stretched into the 2007 top. They only made it worse. And they're not going to negate this cycle. They've only made it worse. And, so manipulation, yes, it's real. Yes, it has an effect on price. But it doesn't negate the cycle.
Well, you mentioned, too, that the more they try to manipulate the markets, the worse they're going to make any downturn.
Absolutely. Because the statistics historically have always been fulfilled. And so if you manipulate it, and I think maybe that's part of the game, is you manipulate it high enough, then you think, well, then that statistic, won't be fulfilled. And maybe they're not looking at it from my statistical point of view. Maybe they're looking at it from some other point of view that's saying that, we don't want it to go below this level. So if we manipulate it high enough when it does turn down, then, this level will hold and everything will be good. But historically, if you go back and look at those statistics, for example, in every secular bear market, every 4-year cycle low has been violated since the inception of the averages in 1896. So, can you manipulate that statistic away? They hadn't done it in 120 years.
And I take a look at China, where the government keeps blaming unpatriotic investors for trying to take their money out of the market. They throw billions of dollars at it, or billions of yuan, and it still doesn't help. And I keep saying, because the Chinese government believes that central banks, central governments can control everything, they don't understand that natural market forces, as you said, the tide keeps rising or falling. You can build a dam, but sooner or later it's going to top the dam.
Absolutely. You can't. That's the thing that is so amazing to me, is that these they need to just back away and let Mother Nature be Mother Nature. It's like trying to stop night and day. You can, when darkness falls, you can turn the lights on outside at the ball field, but damn it, it's still dark outside. And it's the same thing. You can manipulate, but you're not changing the inevitable. You're just not changing it. And that's the thing, and the propaganda of it's unpatriotic to pull your money out of the market because you think the market's going to turn. Come on. That's like saying that I was what was it that I said? They said I was a gold hater. That's what it was, gold hater, because I said that the 9-year cycle had topped in gold. I mean, come on, it's just crazy.
I was going to say, taking your money out of a falling market, I said, I guess it's unpatriotic to run from a burning building then.
Yeah. It makes about as much sense, doesn't it?
Yeah. Tim, thank you very much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Comments about the show can be sent to info@HowStreet.com. And check out our popular YouTube channel, Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.